Next, we're going to look at standard reports regarding financial status reports. We're going to look at balance sheets, income statements, and retained earnings reports. The balance sheet. It's what an organization owns as far as assets goes and what it owes as far as liabilities at any given point in time. All these are recorded on the balance sheet and they represent the overall value of the owner's investment, which is called equity. Here's a neat way to look at it with a historical scale, so to speak, is when we have balance, right? So on one side we have current assets and fixed assets. On the other side we have current liabilities, long-term debt, and equity, and we want to make sure these are balanced. Let's talk about accounts receivable. Accounts receivable includes all the amounts that the organization expects to receive in the near future regarding services rendered or goods sold to customers. Accounts payable. These are short-term liability items, and they are presented with the value of goods or services received by the organization in which payment is immediately due or imminently due. So good examples of these include utilities or purchased goods that you're going to resell. Here we can look at a balance sheet example regarding Natalie's Quilting Center, which is a fictional business. We're looking at the balance sheet from the beginning of February to the end of February 2017. And you can see the assets and current assets and liabilities and current liabilities and things I've circled there. What we're looking at is after all of our assets are total $101,250. And then the same goes with the liabilities on the 1st of February. And as you can see, when we move to the right, we've increased our cash assets. Our accounts receivable has decreased. Our inventory has decreased. And our assets as far as a fixed asset building has stayed the same. So overall, we've decreased a little bit as far as our line total. Then we look at the accounts payable. So accounts payable has decreased. And then our long-term mortgage has decreased as well. So maybe we had a mortgage payment in there at some point. And then you can see the equity has changed. So we've moved from 44.7 to 46.02 as far as our equity. So we're increasing our equity as we pay down that. And that concludes standard reports.